Welcome back to EDS, and in this video we are going to take a look at how you can write your own options contracts, collect a premium upfront, and generate consistent returns year on year. We're also going to have a look at how you can manage some of those positions and how we've been managing some positions in our portfolio, in one of our portfolios. So first thing we want to do is let's look at how we can find new positions. Okay, so what we want to do is we want to pull up a watch list. It's just a list of things that you can trade. It doesn't matter what's on there. Just put together a list of all kinds of different things. This is just a pre-made watch list. You can make your own. Doesn't matter. Once you've got that list, you need to then see where you are in the options cycle. So if we go over to the trade tab, we can see here, obviously we're just looking at UAL at the moment, but we can see here we've got our weekly expirations denoted by the orange W, and then everything else is our monthly expirations. So our next monthly expiration is September 20th, and then the one after that is October 18th. We're going to stay away from the weeklies for the purpose of this video. There typically is less activity on those compared to the monthlies. September 20th is 10 days away. That's not enough time for us. So we're going to go to the October 18th, which is 38 days away. As you can see, we have got a position on UAL. But the purpose of this at this point is just to see where we would be selling. How far out are we going to be selling these contracts? So 38 days is where we're going to be looking. So we go back to our watch list. So now we can filter out everything that has earnings over the next, say, call it 40 days. Right, as you can see, we've already got it selected here on 39 days, which is perfect. So everything here does not have earnings over the course of the next 39 days, which is perfect for us. We do not want earnings happening whilst we are in a position, unless, of course, if it's specifically an earnings play, but you do those slightly differently. So for the purpose of this video, we've now got a nice list of things that we can look at trading. Next thing we want to do is filter everything, or order everything from high IVR to low IVR. The reason for this is we want to sell. We want to sell volatility, basically. So we want to sell when volatility is high and play the contraction. So at the top here, we've got United States Steel. We went over that yesterday, so we're not going to go over that. We've got British Pound Futures with an IV rank of 93. This could be a nice position here, but we're not going to go over futures today. It is slightly different. Intel's another nice one. We have already got a position on it. And you basically just want to go down the list and just kind of see if there's anything that you like. Okay, you want to keep an eye on the liquidity indicator over here. Make sure everything is 3 or 4 star. You don't really want to be going below that. Oracle has had its earnings recently. QCOM with an IV rank of 68. I think we can have a look at QCOM today. We have already got positions on SMH and AMD, so we're not actually going to place a position on QCOM, but by all means we can still have a look and see how you can find these positions. And QCOM might actually fit in your portfolio. So there we go. So we've clicked on QCOM. Of course, 38 days out, October 18th. Now we are presented with the options chain. This orange bar here shows you the expected move of QCOM over the next 38 days. So what we want to do is find the delta column, and we want to be somewhere between 16 and 20 deltas, right? So we can see here 20 delta on the call side, which is the 180 strike. And then if we go over to the put side, there isn't a 20 delta, there is just a 22 and a 16. So let's say if we go to the 140 strike, which is a 16 delta, we do have a negative 4.48 deltas on this position. And we could always just push the put side up to the 22 deltas and be slightly more delta neutral. I think either way you'd be fine here. So let's just say if we go with the 140 and 180 strikes, this green bar here shows you your break even, and as you can see here, the green bar covers the orange bar, which means that your break-even points are wider than what the expected move is, which will lead to a high probability of profit. And that's also denoted by this probability of profit here in this corner of 71%. Very, very high probability trade. As you can see here, Ivy rank is 72.2. We will collect $400 in premium up front, and it only requires 1.6k in buying power. Now I know 1.6k might be too much for a lot of people's portfolios. However, the amount of the amount of premium we are collecting off of this in exchange for 1.6k being tied up is actually very, very good. This is a very, very nice return on capital for a strangle here in QCOM. So with that being said, if you did want to reduce the amount of buying power required, you could always just you could always just buy another contract a little bit further out of the money. So we've sold the 180, we could just buy the 185, $5 wide, right? We sold the 140, we buy the 135, $5 wide. What does that do? This reduces our buying power requirement. It reduces our premium that we collect, but it also reduces our buying power requirement. It does reduce our probability of profit. And we do have less daily theta decay. However, we do have a higher return on capital overall. So one is not better than the other. Everything is the same, but just different. And as you go through your options trading journey, that will start to make more and more sense to you. You just need to make sure your position sizing is correct. So that's how you can find positions. And obviously, if QCOM fits in your portfolio, that looks like a great. It looks like a great underlying that's ready to be traded. Okay, so if you have a look at our portfolio, we've just got everything ordered in terms of P&L open percentage. So CMG, LUV, we're not worried about. Hopefully we can get out of these positions with a little bit more profit than what's currently on there now. Everything else just needs time to work. The only major mover was UAL. If we have a look at UAL in recent times, price has just blasted towards the call strike. So what we did do yesterday is we did roll the put side up. The original put contract was at 35, which is down here. We rolled it up to the 42 strike, and we also collected a additional 55 cents in credit, bringing our total credit on the position to $1.65. Price has pushed quite heavily towards the call side. Hopefully we can see a bit of a retracement from there, and hopefully it can give us a nice opportunity to exit for a little bit of profit. And other than that, that was the only major thing that's happened in our portfolio with UAL. We did have another SPX 0 DTE trade yesterday, which you can see here. Again, everything expired worthless. We kept all of the premium. Again, that was also in our Discord group. So as we can see, this is from yesterday. We placed the SPX Iron Condor 0 DTE trade. We made the adjustment on UAL, and then obviously the Iron Condor expired worthless. So we kept 100% of the premiums. So we made some really nice money there on those positions. The only other thing that you do need to make sure you remember to keep in check is your position sizing. So now that you know how to find positions, what managing positions looks like a little bit, you need to make sure that the size of your positions are in check. So let's say, what we've got is we've got this position sizing template, and the way it works is you enter in the size of your portfolio, say 25,000, and then and then you enter in the VIX level. So let's say the current VIX level is at 19.2. Everything will then be calculated for you automatically. All you then need to do at this point is just use this information as the guideline for your portfolio. It will tell you how much buying power you need to allocate to each defined risk position, undefined risk position, and how much of your portfolio you should allocate to short premium in total as well. And there is an explanation here. You can get yourself a copy of this for free inside EDS Premium. Inside, what is EDS Premium? It gives you exclusive access to all of our portfolios inside our Discord. So it allows you to copy our trades, make money with us, and you also get a full course. So you can learn and earn at the same time. No prior knowledge or experience is required. Of course, it is a Discord group, so you can speak to myself and other like-minded individuals. There's a 100% money back guarantee. So if you've gone through the full course, followed our trades for 6 months, and you haven't been profitable, then we'll work with you until you are, or you can request a full refund. So it's completely risk-free from your part. And right now it's £1 a month. The price will increase. However, whatever price you get in at, you are locked in at. So if you got in at £1, you never need to worry about any future price increases. Your price will stay the same every month. So with that in mind, I will see you guys on the inside.